On Point with Craig's Investment Partners.
All right, good morning, everybody, or good afternoon, or good evening. You could be listening to this anytime. But what's not in question is the fact that I have to say the information provided here is general in nature. It's not financial advice. It doesn't take into account your situation, objectives, goals, or risk tolerance. All investments are subject to risk and none are guaranteed. So before you make any investment decisions, you should always talk to an investment advisor, and you can find out more about our services in that regard at our website, which is craigsip.com. All right, let's look back on last week. Another good one for most share markets across the board, actually, but in particular the US. The S&P 500 in the US just keeps going up. Had another very strong week last week, up 2.6%. So that's the fifth week in a row that the market has risen. And that was actually the strongest week we've had since the end of March. So it just continues to perform very well. US shares are up 15% this year, or the S&P 500 is at least, which means that index has rebounded 23.3% from the lows that it fell to in October. And it's not quite back at the record highs that were reached in January of last year, January 2022, but it's getting closer. It's just 8.1% away from those levels now. We've had what are US investors optimistic about? Well, the Federal Reserve last week left interest rates unchanged. So that's the first time in close to a year that they had a monetary policy decision, and they didn't increase interest rates. They just left rates unchanged. You've also got ongoing optimism over artificial intelligence and what it might mean for productivity and so forth. So a lot of the tech stocks are pushing higher as investors get very excited about that. Time will tell whether they're a little bit overdone. Many people think that maybe they've got a bit ahead of themselves and there's just a bit too much excitement over AI. We all know that'll be a big deal in the years to come, but maybe they've just got a little bit ahead of themselves in the short term. But that is a driving factor at the moment. We've also had more evidence that US inflation is headed lower, and it was just on Friday night we had the University of Michigan survey. 1 year inflation expectations down to 3.3% in June. That's the lowest level since March 2021, and it's just another piece of evidence that the belief is that the Fed is getting inflation under control, and we all know inflation expectations are equally as important as actual inflation because they drive people's behaviour. So that's a good thing. And we've also had further signs that the labour market in the US is beginning to ease. We had US weekly jobless claims come out on Thursday last week, overnight on Thursday, and they remained quite high, the same as they were the previous week, and that was the highest levels we'd seen since late 2021. So again, that is just providing people confidence that what the Federal Reserve is doing is working, getting the labour market, causing it to ease a little bit, causing inflation to come down, and that's obviously good because it means you won't see too many more, maybe no more interest rate hikes, and at some point the Fed will be able to reduce rates. We'll talk about that a little bit later because they did have the meeting last week, as I mentioned. But anyway, US shares are very strong, up 15 odd percent year to date, which is fantastic. Other markets were also pretty good. We had the European market up 1.5%, the UK up about 1.1%, Aussie up about 1.8%. The NZX 50 locally rose 0.9%, so shrugging off that pretty subdued GDP report, which we'll also talk about. On the interest rate front, US interest rates up slightly. The 2-year Treasury yield went from 4.6 to 4.7. The 10-year yield still sitting at about 3.8, so not very much moved, but it was a bit of a roller coaster through the week. you had lots of things happen last week, and sort of rates were up, then they were down again, then they were up, then they were down again. So there was a lot of movement. But they didn't end up very different sort of on a week to week basis. It was a similar story here. We had a volatile week, particularly on Thursday. You had that Fed commentary come out, and that saw interest rates go up. Then we had our GDP numbers, rates were down again. Then you got some Aussie employment data, which was quite strong, interest rates up again. But you look at the change over the week, and there wasn't much difference at all. The 5-year swap rate, went from 4.60 to 4.62 over the course of the week. So a lot of movement sort of through the week, but the week ended pretty much where it started. Looking back at some of those key releases, the Federal Reserve was the key one last week, and they left interest rates unchanged, which was mostly expected. It wasn't completely expected, but it was sort of, priced into the tune of about 70%. So it was mostly expected, but people did see a chance of them moving. They chose not to. They left rates unchanged. However, they did open the door for future interest rate hikes, and their dot plot, as they call it, which is sort of the internal survey they do of their voting members, and everyone sort of says where they think rates will go over the next year or two. So it's sort of a bit of a proxy for where the Fed's at in terms of their train of thought. That dot plot did suggest that the Fed funds rate will end this year higher than we expected before. So they've got another rate hike or two penciled in their thinking. That might not happen. I think they will be very data dependent from here, and what that means is that as each economic release comes out, whether it's the jobs report, whether it's inflation, whether it's this, whether it's that, those things will they will respond to the data. So if things continue to be very strong and very inflationary, they probably will hike rates another 1 or 2 times. But if inflation keeps going in the right direction, as it has been, and if the labour market, not weakness, but just seeing a little bit of an easing of late, if that continues, then with a bit of luck, they might not have to do any more. They're at 5.25%, which is just behind us. But for them, that's high. That's the highest since 2007. So my suspicion is that they'll either stay there, and that'll be it, or you might get one more rate hike coming in due course. But we'll reserve the right to change our view as we see new information, just like the Fed is doing. They've got 4 more meetings this year. So the next one is in late July. Then there's mid-September, and then there's a couple more. So late July is sort of the next opportunity, and that'll be a really interesting meeting. We'll be monitoring all the data that comes out between now and then to see what it points to. So that was the Fed. Sort of a bit of both, mixed bag. You can sort of choose what you'll take from that. No change, which is sort of good, but then opening the door or suggesting that you might push through a couple more hikes later on. So they're probably hedging their bets as well. The ECB, that's the European Central Bank, they had a meeting. They increased interest rates, fully expected. So they're at 3.5% now. That's the highest in more than 20 years. They're still playing catch up, compared to the Fed in the US or the Reserve Bank here in New Zealand. Remember that this time last year, they had negative interest rates, right? So they were quite slow to start normalising monetary policy, and they've probably still got a little bit more work to do. I think there's probably 1 or 2 increases more coming, so they might end up at 3.75, maybe 4% in terms of their policy rate. Staying with the global data and indicators, we had the US inflation report for May. This was good. We saw a pleasing moderation in inflation. The CPI increased 0.1% for the month at the headline level, and that means the annual headline inflation rate slowed to 4.0%, which is good. That's the lowest since March 2021, more than 2 years ago, and it's well down from 9.1% from June last year. That was a 41-year high. So 4 is still twice what the Fed would like it to be, but it's absolutely coming down in the right and going in the right direction. And having been 9.1 pretty much 11 months ago. Um, that's great news. So look, hopefully that continues. Core inflation still a little bit higher. It came in at 5.3, which pretty much as expected, but it's not coming down quite as quickly. So that was the global news. Here in New Zealand, it was another busy week. We had the housing market report, and I recorded an entire podcast on what I thought of this. And I wrote a piece of work on it too, just a couple of pages with my thoughts. So I won't dwell on it because you can just go and hunt that out and have a listen. Long story short, I think the slump is nearing an end, and I think that we're pretty much at the bottom. You never know. Maybe there's a little bit more weakness to come. Who knows if there is? Probably not much though. But I get the distinct feeling that things are stabilizing. So that's good news from an economic perspective. Good news for confidence. Good news for sentiment. However, don't get your hopes up that the housing market is about to take off again and that there's huge value there, because there isn't. Prices are still quite expensive and not particularly affordable. And I actually don't think it's going to sort of get away on us again. So I'm in the camp where it's probably done falling, but it's not necessarily going to rise significantly. It might rise a little over the next sort of little while, or it might just sort of bounce along the bottom and kind of go sideways. There's still quite a few headwinds ahead for the housing market, but the fact that prices stop falling aggressively will be a good thing. But go have a listen to that podcast, and you'll get a clearer picture for why I think what I think. Then you can let me know if you agree or disagree. Everyone's a housing market expert here in New Zealand. Also, we had our GDP data. This was for the March 2023 quarter, and GDP fell 0.1%, which was in line with market expectations. That's what all the economists were expecting, but it was below what the Reserve Bank was expecting. They were expecting a 0.3% increase. So at minus 0.1, that's a little bit weaker than where they were at. So because in the previous quarter, which was the December quarter, we saw a decline then as well of 0.6%. So you've had down 0.6, then down 0.1. Some people might consider that to be a recession, because a lot of people consider 2 consecutive quarters of contraction to constitute a recession. So that meets the criteria, and that's why you saw that in some of the headlines. Now, I wouldn't get too hung up on that. It's a pretty arbitrary rule. And I don't know who even came up with that rule. It's really just one of those kind of rules of thumb rather than something that matters a lot. I suspect most sensible economists would say it's not really weak enough to consider it a proper recession. Down 0.1%. It's so close to zero. It's within the margin of error anyway. There's every chance that it gets revised up to be a little bit higher or to be sort of flat. So, it might not happen anyway. But I think when you're thinking about recessions, there is a range of recessions. There's bad ones and there's less bad ones. But it doesn't even really stack up for me as one of the mild ones, because you just haven't seen. It's not deep enough in terms of the decline in activity, and it's not broad enough either. You need to see weakness across the board. You need to see things like unemployment going up and a bit more pain out there. So for me, it's a pretty weak recession. It's if that's going to call itself a recession, it should be embarrassed about that. It should. We need to see more weakness than that to really consider it something more significant. So who knows where we go from here. We will just keep an eye out on the economy. But I guess what it does tell us, whether it's a recession or not, make your own minds up. But the trend is still clear. The economy is slowing from the overheated levels of a year or two ago, and things are getting more difficult. So there'll be some sectors that are feeling the brunt of the slowdown more than others, and remember that's sort of an aggregate measure of what's happening right out there across the economy. So you've got parts of the economy like tourism that are actually going pretty good at the moment and are very, very solid, and then you've got other parts of the economy especially those parts of the economy that are more linked to interest rates, such as construction and anything sort of related to that part of that sector. They're well and truly in recession. So there'll be elements of the economy that are uh, doing quite well, some that are in recession, some that are kind of just in the middle going sideways. So that was most of last week's news. So that's sort of the roundup there. Looking out this week, starting internationally, June flash PMIs for many of the world's biggest economies, and PMI stands for Purchasing Managers Index. Um, so these are essentially activity indicators, really. They'll be very interesting because they come out very quickly. So these will be June, covering the month of June. So it's a very sort of finger on your pulse sort of measure of what's happening out there. We'll get them for Australia, Japan, the US, the UK, Europe. Um, and all the parts of Europe, France, Germany, elsewhere, and so forth. So the Aussie one, I think, is first cab off the rank 11 a.m. on Thursday, maybe. I think it's on Thursday, and then I think you get the Japanese one to follow on the Friday just after lunch, and then the UK and Europe and the US sort of overnight that night. So they'll be sort of late in the week. But what will I be watching for? Well, everything really. How is growth tracking? How is activity tracking? Is there still a gulf between the services sector, which is going really well, and the manufacturing sector, which is in a major slump? That's a really interesting gap that's developed. So we'll be watching that. And what are the inflationary indicators telling us? So that'll be really interesting to watch those flash PMIs. On the central bank front, obviously had the Fed last week, which was the main event, but they will be in the spotlight again this week. Fed Chair Jerome Powell will be providing his testimony to Congress. So every 6 months, I think this has been the case since the late 70s, every Fed chair 6 monthly has to present to the House and the Senate. So I think Powell is talking to one of the House committees on Wednesday, and then a Senate committee on Thursday. So they'll quiz him about the economy. Where do you think things are going? Why are you raising interest rates so aggressively? Are you going to push us into recession? What do you think is going to happen with unemployment? All manner of things. So markets are obviously really interested in watching that exchange, because they will, be able to listen to some of his responses and get some further insights into how he is thinking. So this will just build on what we saw from the Fed last week. So that'll be a key event to keep an eye on, both of them. Wednesday and Thursday. Probably Wednesday the more relevant one. We've also got the Bank of England, which is meeting overnight on Thursday, I believe, and they are likely to hike interest rates again. So their policy rate is 4.5%, I think, off the top of my head, and they'll go another 25 basis points this week. I would expect. So that'll see them at 4.75. That's the highest since 2008. The UK's got a bit of a problem, because inflation, while it's come down from 11 point something, it's still tracking much higher than they expected it to, and what other countries of the world have come down to. So their headline inflation rate still 8.7%. The US is down at 4 now. 8.7, that's super high. So the Bank of England has more work to do than many expected, and end of this week they'll end up at 4.75. Current pricing suggests that they could have to go as high as 6%, right through into next year, as they try and sort of get a handle on things and get this inflation under control. That would be the highest that we've seen in terms of their policy rate since 2001. So we'll have to wait and see whether they do have to go that far. But that's one of the reasons the British pound has been quite strong. Many people, a lot of you probably follow the British pound, and it's been very strong. So that's why, against the Kiwi dollar, the NZ dollar pound cross rate, we're down 48 and a half ish, 48 and a half to sort of 49 and that's about 7.5% lower than where we started the year. So that's been a good thing for New Zealand investors with UK holdings, because UK shares, as an example, are only up about 2.5% this year, been pretty subdued. But in New Zealand dollar terms, they're up 10 or 11%, because you've had that currency movement that's gone your way. And if you're exporting to the UK, you would probably be quite happy about that too. That currency weakness will be making you quite a bit more competitive, and that's why the pound has been so weak, because inflation's been so high, and we're all having to sort of ratchet up our expectations of what the BOE might have to do. We actually get an inflation report about a day before that Bank of England decision. So that decision's on Thursday, and the CPI report, the latest one out of the US, comes out on the Wednesday. So markets are expecting that to come down a little bit, but not dramatically. It's expected to come down to about 8.5, which is obviously better than 8.7. But geez, you've got a long way to go. So that will be really interesting and worth keeping an eye on too. Here in New Zealand, it's a pretty quiet one. We've obviously had plenty going on lately. Last week with the GDP report, that was the important thing, the big one that was watched very closely, in the house price data. But this week a little bit quieter. We've got another dairy auction. Dairy prices haven't been going the direction that many farmers would like. $8 payout, not bad, but remember, $8 isn't what it used to be, because costs are a lot higher. So they would rather that be $8.50 or $9, just to sort of bridge that gap a little bit more. So be good to see a bit of stability or a bit of a turnaround in that dairy auction. We've also got the ANZ truckometer, which is a sort of an activity index sort of thing, gauge based on what you see from sort of heavy vehicles, light vehicles, moving things around the country. So that's on Friday, and that's about it, to be honest. Not much on the corporate front, either here or elsewhere. The only company result that really caught my attention was FedEx on Tuesday. Always interesting to sort of see what FedEx is doing. You learn a lot about what's happening with the global economy, the US economy, sort of in the same way you do from the freightways or the main freight result in this part of the world. So FedEx will be something I'm watching on Tuesday. But yeah, other than that, that's probably about it. June flash PMIs late in the week, and the Powell testimony to Congress, and keep an eye on the UK CPI, and then the Bank of England decision, and sort of see what that does for interest rate expectations and for the British pound, because that matters for us either as an economy. We still export a few bits and pieces over to the UK, but we do have, as a nation, we do sort of hold a lot of financial assets and investments in that part of the world, investment trusts and other sort of UK businesses that we like. So that's worth monitoring. All right, that'll do me. Thanks for listening, everybody. We will talk again soon.
For more insights, visit craigsip.com.